So now we're just going to get some of the feedback. So do you want to start telling me what you thought investors want? Trish has got a microphone. So who wants to go first?
Hello, I'm Dot McCarthy, and I'm in the process of founding Roundy Club, which is a platform that allows farmers to link directly with consumers. So we've just been talking, us three here, about this question, and we think we sort of put ourselves in the investor's shoes. What would we think if we had a big pot of money and we wanted to invest in someone? And the most important thing we thought was that your money would be safe and that you've got a likely return on your investment. And the second thing is that you've got that cultural fit with whoever you're investing in. So they've got the same life vision, ethics as you, and they're sort of aiming for the same, they have a similar sort of idea of how they want to live their life to you and like run businesses to you. I think that's pretty much it, wasn't it? Oh yeah, and tax breaks.
Yeah. Excellent. It's a really important point about the cultural fit, because it's not just do they have the same ethics as you, which is definitely true. It's actually also, are they the kind of person you can get on with? And that ethics thing, that can be that clash. So it's really important you're going to be able to get on, particularly with angel investors. Any more?
Emmanuel, Prindy. Yeah. We had an interesting conversation. One was about the general stuff, the team, the product market fit. Mm-hmm. But we also discussed the type of investor. For example, if it was a fund manager, they might have a slightly different view than someone who was investing with their own money. Mm. And maybe across different markets, people's got different attitudes. So somewhere, like here, for example, people might want to see everything in line, whereas other places where people's maybe had, or investors I should say, have had more experience or more money in the pockets, they may see seed money as a little bit more fluid than in other places. So it was just an interesting conversation about different
Yeah, and certainly there's a perception that in America, because some of the investors there literally have plenty of money to invest, they're a bit more, that people come away and go, oh, in America, you've just had an idea on the back of a fag pack, you can get £1 million for it. The reality actually in America is very, very different. And if you went to America now and said, struggled to raise investment in UK, but I've heard America's great and I want to invest some money and maybe base myself here, they would be disinterested from the beginning, because what they want to see is that you've actually been able to raise investment from people that already know you, that are kind of part of your network. And they see it's a really big negative if you've not been able to convince anyone that you know to put any money in. I've been to West Coast, and that was the feedback. Well, they told me, can you tell people to stop coming over and asking us for money, unless they're at like really later stage and they've already got lots of investors already said yes, and then we'll come in and we're in a position to put in big money. But we've had another one at the back.
We were trying to look at the my name's Henry. What was the second question? We're working on that. So we're working to challenge the loneliness epidemic at the moment, the loneliness epidemic. So we were looking at the common themes. All investors have different reasons for wanting to invest. Some are looking for returns, some not necessarily. But the common theme, we thought that they all want to put their money to their view of good work, or money to good use, I suppose. But actually there's some different outcomes beyond that. So yeah.
Yeah, and that's definitely true. And I'm going to come on to that in the next slide, because I think all of you picked up, thank you very much, Trish, all of you picked up on the fact that it depends on the investor. It depends whether it's an angel or a fund manager. And I would say the motives for angels, you'll see them making money right at the bottom. Making money is still really important to them. So they're investing because they want to make a profit on that money. But actually, a lot of them have done exactly the same thing as you. They started out a business, they made the business grow, they got to the point where they're able to sell and exit that business, and now they've got the money. Now, I think a lot of them had the idea that they would make millions of pounds, buy a big house, sit in the garden, relax, having been able to make all this money. But in fact, a lot of them want to give something back. They get very bored immediately because they've been entrepreneurial all their life, and they want to continue doing something like that. They want to pass on their experience. They want to expand their network. They want to talk to other angel investors and other people that have been the same thing, because it's quite lonely being at the top of your business. You don't tend to make that many friends when you're that leader at the top making those tough decisions. So actually afterwards they want to expand out that network. They want bragging rights just as they're about to tee off, just invested in this company, and they're kind of showing off to some of their other friends they've just made. And when they're making money, I'll come back onto this, they want to make big money. And we talked about some safe bets earlier. Very, very rarely do I come across an angel that's, well, their portfolio looks something like, these are some risky ones and these are some safer bets. They're going for, always, and this is tech angels, for companies that they think will be huge. All of their investments they think will be huge. And they're assuming that a whole load of them are going to fall away and they're going to be left with a handful that will make all their money for the whole portfolio. So you need to bear that in mind too.
James?
For funds,
James, you've got
Sorry.
one more here. This
Got it.
man, this gentleman would like to say something.
So I think some investors are looking to solve really difficult problems. So they'd rather invest in really talented engineers or people that have got something quite proprietary where there is going to be no competition and kind of a bit different from the traditional kind of get the product market fit right. It's if they manage to solve a really difficult computing problem, they could then help them put the business, the salespeople, and help them get all the rest of the players that they need to get the product right. So sometimes it's just a matter of having the right proprietary tech.
yeah, I would say that is true, and I've heard of in fact, I think it was a VC that invested in a company because they thought they were the best tech team they'd ever seen. So almost forget the business idea, forget the actual founders and the salespeople. They just saw that team, saw how they worked together, and saw the level of expertise, and were like, actually, if we buy this, we could almost give them anything. I would say that's pretty rare, though. I think still most investors, because they've been that founder, I guess maybe they're a more kind of tech-centered investor. They might, they've had a tech background, they might be looking at that, but most of them will be looking for the whole kind of package. And certainly for funds, you've got to be conscious, as I said before, that 10-year cycle, where are they in that 10-year cycle? And funds, when you're managing a fund, you have what they call a 2 and 20 split. So a £100 million fund, they're going to take 2%, £2 million to manage that fund over 10 years. Now, that's not an awful lot of money to run a whole venture capital firm, if you've just got one fund, for example. Where they want to make their money is from that 20%, which is the 20% of the profits they're going to make on top of that fund. So they'll get the £100 million back, and anything on top of that, they'll take 20%. Now, that's where their big money is. And so they're really, really keen and really, really motivated. And this is where you've got to make sure that your motivations are the same as theirs. They really want you to grow hugely, but crucially sell. And if you can sell within those 10 years, perfect, because that's the kind of time frame that they've allowed for. So by the time you go to a fund, they want within that 10 years, and maybe if you go there in year 3, like I said before, you've only got 7 years, they want that exit within that 7 years. And they may or may not be really clear when they talk to you about that, but that's what they want. And they might be less motivated to wait an additional 5 years for an exit twice as big as actually just getting an exit within that 10 years, because a little bit like estate agents just want you to sell you a house because that's how they get the commission. They're not going to see that profit until you exit. So they're really, really keen on pushing for that exit. They also have a set of fund criteria. There is a human element to it, though, too. So fund managers talk to one another. They tease each other about the ones that they've missed out. And they're really, really keen that, because once they've invested in you and closed out their fund, they're going to have to do the whole thing all over again and convince more investors to invest in their next fund. And each fund tends to get bigger and bigger. So their success relies on them having a reputation of investing in good companies. And so they want that kind of reputation to continue. So that's a lot of their kind of motivations around that. And as I said before, every investment in their minds needs to make 10 or 20 times the investment they put in. So they put in £1 million, they want to see £10 million, they want to see £20 million. And that's because 1 in 10 will fail. And when I'm doing workshops for angels and I'm talking to them about you need a portfolio, you can't just do one investment, because if only 1 in 10 really succeeds and maybe 7 fail and 2 do okay, you really need that one success. So you need to have at least 10 to get that. In fact, I say to make sure you get that 1 in 10, have 15. Because you need that kind of range to get that one big one that's going to pay for all the rest. So that's how they balance their portfolio. They have it wide enough so they can get that one big success, or 2, and that'll be it. They'll be really happy. Don't worry about writing this one down. We're going to come on and talk about all of these in more detail. But angels and VCs will be looking at your team, a solution that solves a specific problem, your product. They want to know how it works, how does it make money, and this is where you'll bring in, maybe a sales projection, things like that, which they'll all be taken with a pinch of salt unless you've got substantial sales so far. Traction, and then opportunity. How big is the market that you're entering? How big is the opportunity? Are you one of a number of really fast-growing companies in this same area? They're going through these one by one. So don't worry about this being about the pitch. We'll be talking about the pitch in section 2. This is just, the pitch is essentially how to get someone interested in your company. And once they're interested, then you need to tell them about all those different areas that we just spoke about. So team. Investors, when you ask an investor what they want to, why do they invest? What's the kind of key thing they look for? If they're just going to look at one thing, they'll always say team. And so every pitch deck you see has always got the team page, because they're like, yep, haven't forgotten that piece of advice. And they'll have some nice pictures, maybe like this. And you'll have, this guy, Mr. T is his COO, Hannibal is the CEO, and they'll have nice little job titles, and they'll say, okay, and this is our team, and they've got lots of experience before, and they're great. And actually, what they want to know is, can that team make things happen? And a great way to prove that is to tell them what you've done so far. So the annoying thing is, before you've got any money, they want to know, what have you achieved with no money? What you've been able to tell them is, okay, we managed to do X, Y, and Z, and we've got our first customer, we've built the product to this stage, and we've done that with nothing. Because you want the investor to think, wow, they did that with nothing. Imagine what they could do if I gave them some money, pour coal on that fire. Are there any gaps in your team? So you might have no sales experience on your team, which might be a problem. And you might at that stage think, okay, well, we need to go and find someone. But actually, you might not be able to pay that person, so you can't bring them in yet. What you need to do is reflect, actually, do we have all the necessary skills to take the business to the next level? And if you don't, identify what that gap is, potentially even who will fill it. Because an investor is going to ask you, so who does your sales? Oh, none of us, we're not really salesy people. Actually, what you say is kind of preempt it and say, look, this is our team. We feel that we have a gap in sales. And in fact, we've already found the person who's going to fill that gap. We can't bring them in until we get the investment. That basically shows the investor that you're mature, you're able to take a strategic point of view, you're not all trying to do all the jobs in the company, and you actually kind of separated things out and worked out how to take things forward. Include things like experience of the team members. So-and-so worked for this company, particularly if they've done similar things, so if they've worked in a startup before, they managed to build a product to this, okay, tick. They know this market really well because they've got 5 years experience of selling in this market, great. Those are the kind of things that they're interested in. You'll sometimes be asked, particularly if there's a pitch, I've seen pitch of 7 people, never do a pitch of 7 people all trying to talk to an investor. But when you've got multiple people and you've got maybe the whole team, there's 3 of you, the investors might ask you, so who's in charge? And if all 3 of you say at the same time, we all are, that's not what they want to hear. They want to know that actually you can make decisions. And if you have an argument, how is that argument settled? So if you all want to go off in 3 different ways, that company is never going to work out. You actually do need someone who can say, okay, right, the buck will stop with me in terms of this. Or you just split it and say, decisions about this lie with him, decisions about that lie with her, decisions about that lie with him, and then ultimately we kind of work it out. And you can even describe a kind of scenario where you get an argument settled. But I think that the most important thing here is when people say team is important, it's about what you've done and what you've done together. And you've kind of proven that you can work as a team and get things done, just like the A-team. So can you be locked in a garage and find welding equipment, get your vehicle back on the road and burst out? That's what they're after. So, solution. And the solution is a solution to a problem. Sometimes the solution is thought of before the problem is thought of. And investors see this quite a lot, and I've seen this quite a lot, where people go, I've made this really, really good product that could do this really, really amazing thing. You're right, that's a great product, does an amazing thing. Why? Well, yeah, but if you could buy it and it could do X, but yeah, but to find the problem and focus on the problem. And sometimes you've got the problem yourself in the back of your head, and that's why you came up with the solution. But you need to bring that forward and be really conscious of what the problem is, and be able to, when you're having a conversation with investors, be able to really clearly define that problem. And the more painful the problem, the better, because people will be willing to pay for it more, and people will be willing to access it more. They might also say, when you're talking about your solution, your product, how difficult is it to implement? So if I've got a piece of software that made cloud services run more easy, I might say, okay, I can pitch this to UK Fast. They run cloud services. I've got a plugin that will just make things work easier. Okay, well, that sounds brilliant. There's lots of, UK Fast got loads of money, haven't they, Trish? Loads of money. I'm sure that they'll buy your product, but actually, when you go to sell it to them, you say, yep, okay, well, let's do a pilot. Let's see if it works. Okay, well, the pilot's going to cost you money because I need 5 people to implement it. It'll take about a week, and I need all your tech guys, and you need to give me X, Y, and Z. And it starts to get really, really complicated. And investors are really keen to nip that in the bud early and work out how easy is it for you to implement it. Is it just download, it starts working? How much implementation does it? Do you need a lot of phone calls? Will you need to come into our office? All these kind of things. Everyone with Google Glasses? Didn't really work out, did it? But all they need to know here, this is a danger here that you'll get bogged down in detail. They want to know the product because they're understanding there's a solution to a problem. How does that work? How does it work? If you go into a lot of detail before you're asked, they might ask you to get into more detail, but that'll be much later. That'll be part of the due diligence, in fact, often. Really simply, how does it work? And if you can nail that in a few simple sentences so that an investor, a non-techie, can understand, perfect. Often, a good way to do this is to say, and actually this is a very, very common question as well, when you're seeing a lot of pictures, sometimes you see one, you go like, I get that that's solving a problem, and I get that it's a good product, and yeah, quite like the team. So, but how does it work in terms of, how does it work? Because you might say, well, the software does X, Y, and Z, but actually just say, okay, if I was a customer, I would be approached by a member of my team. They would say, do you have this problem? I'd say, yes, I do, actually. I'd love to have a solution for that. Okay, and just take them through that customer journey of how they would find you, how they would buy it, how they would implement it, how it would give them the results that they're going to want from that, and why they would renew their subscription if it's a kind of subscription model at the end of that year. So take them through a little bit of that, and that can be an easy way for a non-techie to understand how that tech product works. In terms of making money, they want to be really, really clear on this. And what you'll see with early stage startups is they'll have a pricing model and a way that it's going to make money. And you'll often get feedback from an investor going, I understand that, but have you thought of this? Have you thought of subscription model? Have you thought of this model? Have you thought of this model? And they'll immediately start throwing out different models to you. So you need to have properly examined all the different ways you can make money from your business. It's great because they might come up with something that you hadn't thought of. But you need to go in pretty well prepared that if they say, have you tried this model? You can say, yes, we tried that out, we discussed it with the customer, and they said, no, they prefer our model. Great, conversation over. But that they are going to examine that quite a lot. How much does it cost for you to find each client? There's a great company I spoke to recently that was describing how much money they could make off each client, but actually they were physically going to have to walk in. It was a kind of a retail tech. Sorry, I blast everyone's eardrums. It was retail tech. They were going to physically walk in. This was the plan. Walk into every shop and talk to the owner of every shop and convince them to use their tech. And they were like, well, that's fine, but how many hundred people are you going to get when this goes across the UK? You're going to have someone in every town and city going door to door. So that they do want to understand how much something like that is going to cost. And also, this kind of setting a precedent. So it's really about, has this been done before? Is this a kind of easy way into a company? Are you able to talk to the right people or target the right people who are able to make a departmental decision if it's a big corporate and they can buy it? Or are you saying, this is so innovative, no one has ever bought a product like this? That is much, much harder to get those first sales off the ground. And the investor will immediately be thinking, okay, well, this is going to cost a lot more in terms of sales and so on, certainly initially. Traction is really key, and I know for some startup founders this is a really difficult one because they are just starting out and they haven't got any traction. You need to have some traction to be able to talk to your investors about why their money will lead to even greater traction. And an investor will want to know who your customers are, and they'll be really interested in how you got those customers. So that's a really common question, particularly if you only have one. And the worst kind of answer would be like, well, I've got HSBC is one of my customers. Like, wow, that's your first customer. Yeah. How'd you get them? Oh, my dad is on the board of like, oh, dear. Actually, what you want to be able to say is, well, I met the guy, I was sat next to him on a flight, and I managed to convince him, and he arranged for a meeting. And all that just sounds really entrepreneurial. It sounds like you got some spark. Sounds like you can make things happen. That's the kind of thing you want. And if you're able to say, and something is better than nothing. So paying customers would be fantastic, and you can say, this is a paying customer we've got so far with no money, and they've been able to give us some income. But actually, a pilot is also fine if you can't get that. A paid pilot, perfect. But what some investors are quite cynical about is if you say, we've got loads of traction, we've got 20 people signed up, but actually they're signed up to nothing and they haven't paid anything, and we've done 10 pilots and all the pilots look fantastic. And when you start drilling down into it, it feels a little bit like they've just gone out and said, can I give you something, and you don't have to give me any money, I'll just give you this, you just try it out. And that can be quite an easy sell. So the investors are a bit cynical, saying, well, actually, this person has the ability to go and give something away for free, but do they have the ability to sell it? And how many of those pilots, if you do a pilot, if you can get any kind of reassurance from them and say, okay, well, if we charged you £50 for this next time, would you say yes? And you can just say a really low amount just to try and get that yes. So when you're trying to convince the investor, go, look, we haven't charged any money, fair enough, but the 10 pilots we did, the customers really, really liked it. They said they would buy it again, and we've already told them a price, and they're starting to agree on a price. We just need some money to take it to the next level. You're just trying to convince them that actually, once you give them money, you can start kind of making money and expanding it out. So this is where you need to work out how big your market is. And you can do lots of Googling and research and say, okay, I'm in a market that is whatever billion. No one's ever going to go, it's only 100 grand or so. It's billions of pounds big. And the investors will probably know this already because they've seen enough pitch decks in your area, in your market, that they'll probably know anyway. So if you go in and go, it's 10 billion, they'll be like, actually, it's 750 million because someone told me last week. Be careful that you don't, I think I'll come on to this in the pitch bit, but be careful not to kind of overblow it. So avoid saying things when you're talking to an investor. You say, well, actually, it's £500 million worth of, and actually, I've had this. A games company was pitching to me, and it says something like, and I can't remember the statistics. He said, 500 million pounds worth of computer games were sold last year. If we just get 1% of that, that's 5 million a year. Where does that come from? You're never going to get 5%. How many games were released to get 500 million? And I've seen that, if we could just get 1% of that market, forget that, because it doesn't make you sound humble like you're only going to get 1%. It just makes you look like you haven't really got a clue. Are you going into a growing market or a shrinking market? And really crucially, is it scalable? And you can prove whether it's scalable or not by the cost of sales. So you go, actually, we can scale this, and the cost is still going to be kind of minimal, and we can keep selling and selling and selling. But also, you can use examples. So this is where that slide about competition is really, really crucial. So talk about your competition, and you can say, this is what they're doing, this is what we're doing. It's different. It can't be exactly the same. That's never going to work. But it's different, and we're doing it this way. We think we're doing it better. We're able to do it cheaper. We're doing it more innovatively. But actually, even though we think we're a better company than them, because they started 3 years ago, they've got sales of 10 million a year. So we think we can get up to that point and steal a lot of their customers. And there's a new one in the market that's coming up that's doing something different enough. They're not going to take the same customers. Just talking about your customers validates all the things that you're saying about your own business, because you're basically reflecting their success onto you. It's less kind of pie in the sky stuff. Always remember, so investors talk. So angels talk to VCs, fund managers talk to each other. They often kind of leave one VC firm and go and join another one. And investors laugh when they're talking about some companies who said, we're going to do X, Y, and Z. Or, our first customer was HSBC. I met them on a plane. Really? I spoke to that guy. He told me it was his dad who was on the board. And you'll quickly be found out. And it's amazing how quickly those falsehoods get exposed. So, just another quick exercise for you guys. Why do investors say no? So investors say no most of the time. Some investors say no almost all the time. So just from what we've said in these last few slides, just get a sense of why you think investors say no. You can split into teams or discuss on your tables. That could be 5 minutes.